subject of personal financial planning. In the present lecture series, we are talking about investment planning. And while talking about the investment planning, we have talked about various issues of investment. What is investment, financial investment, real investment, the process of the investment, how do you proceed with the investment, the objectives of investments, the factors affecting investment. And in my previous lecture on investment, I talked about few of the investment avenues or few of the opportunities where the investors can invest and get good returns depending on the objective of the investment. So in this process, we talked about stocks, that is equity shares, debentures, treasury bills, mutual funds. Very quickly, just to remind you, basically equity shares is the ownership of the company. What you can buy is that you can buy a part of the equity capital of the company, that is the total capital of the company is divided into the small parts, and each part is called share or equity, right? And an investor can invest, and when you invest in an equity share, it means you become the partner in the company. If the company grows, your investment will grow. If the company is not able to perform well, or if the company makes losses, the value of your investment in form of the equity will depreciate, will get reduced, right? So what it means is the expected return that is generated from the equity that keeps on fluctuating depending on the performance of the company. But nevertheless, it is a very good form of investment, and people do invest in the equity, which gives normally over a period of time higher return than many of the other asset class. I am not distinguishing exactly, I am not at this point of time telling you exactly that this gives better return than other asset classes, but this much I can say that this gives better returns than many other forms of investment, providedly you are ready to take risk, because equity is an asset class where there is an element of risk. As I just said, that if the equity performs well, if the company performs well, the equity in the stock market will also perform well. If the company doesn't perform well, the price of the share, that is the value of the equity, will also not perform that much well. So depending on the company's performance, in the long run, the equity performance will be there. So you can make sometime very good, very high rate of returns over a period of time. Equity has the capacity to make your investments 100 times, 200 times. I'm not naming the companies, but in this present era itself, there are many IT companies. Just to give you a hint, there are many IT companies where in a period of 30, 40 years, means rather I would say 30 years, the value of the investment has gone up by 100 times. That is, 1 rupee if you have invested, it has become rupees 100. This is the capacity of the equity return. That is what the percentage of return or how much return the equity can give. Similarly, if you invest 100 rupees, it can become zero also. So if the company becomes the sick company, if the company makes continuous losses, right? So the value of the shares may not be, give you any good price, or even can become zero or almost equivalent to zero. So this is the power of the equity, right? It can give you high returns, it can create a very high wealth over a period of time, but providedly you are ready to face the risk. This we discussed in the previous lecture, that's why I am quickly discussing bonds and debentures. Bonds and debentures gives you fixed return. It is like a debt that you give to the company, some fixed amount on which you get, the company promises to pay a fixed rate of interest on these bonds. But the element of risk is certainly less than equity. I am not saying that the bonds are risk free, because when you invest in the company, when you invest in the bond of a company, what is bond? Bond is like a fixed liability on the part of the company which has taken the money, right? So it promises to give you a fixed rate of interest to the investors, bond holders. But if supposing some financial troubles arises in the company, then many a times I have seen in the past that even good companies fails to pay the interest amount on a regular basis, or they delay the interest payment, and sometimes even they find it difficult to repay the principal amount. So this is element of risk in the bond investment, but the degree of risk is certainly very less as compared to the equity, because in the equity you are a direct partner. In the bond holders, as a debenture holder, you as a debenture holder, if you invest in the debenture, you are an investor. Similarly, there is another investment avenue that is called treasury bills. Friends, treasury bills are one of the most safe investment that you can make, means with the, almost risk free if I use the word. So these are the instruments which are being issued by the Government of India, that is, they are issued by the RBI on behalf of the Government of India, and they give you a fixed rate of return, fixed rate of interest. It is highly liquid asset. You can sell it any time in the market, and there is no element of risk involved. When I am using the word no element of the risk, what we have experienced over a period of time, the Government of India has never failed to pay its obligations. But it doesn't mean that there is a zero risk, because our experience world over shows that sometime even some governments, I'm not talking of India, but I'm talking of some governments, have failed to pay their obligations in time to the treasury bill holders. So means there is element of risk, but relatively the element of risk is very, very low. So is the return. Because normally we say risk and return correlates, means they go in the same direction. If there is a higher element of risk, there is a higher return also. But treasury bills, the risk is very, very low, but so is the case of the return also. But at present, if you talk of the present interest rate in India, I would say it is giving you 10-year bond yield is around 7%. 7% is reasonably a good rate of return. It is beating the inflation. Inflation in India is 5%, 5.5% at present, and the treasury bills 10-year bonds are giving you 7% return. So which is also beating the inflation. And one of the factor which you consider while making investment is that it should beat the inflation. The return which you get of your any investment must be higher than, or should be higher than, the inflation rate. That way, treasury bills, at least in the present era, is a good form of investment. So because they are very liquid, they are less risky, right? So this is a good form of investment. Those investors who want to make safe investment and they are satisfied with a reasonable rate of return, treasury bills is a good avenue for investment. Similarly, the mutual funds, especially those investors who are not, either they are not professionals or they do not have the knowledge about the stock market, the gold market, the real estate markets. There are mutual funds available in this country where they pool the resources of the investors and invest in some asset class. This asset class may be equity shares, this asset class may be bonds, it may be the real estate, it may be gold, right? The purpose for which you will give the money, in that asset only the mutual fund house will invest. But in India, in a country like India, where mutual funds some 20 years back were not very popular, but at present the mutual funds houses or mutual funds are becoming very, very popular. I just give you an example, almost every month the industry is getting 13 to 14,000 crore rupees as SIP. SIP is systematic investment plans, where every month investors, or every quarter, or at a fixed interval, investors do invest in the mutual funds. So the amount of SIP which mutual fund industry at present is getting on a monthly basis, I am not talking of the total amount, I am only referring to the per month amount which the mutual fund industry is getting. So you can imagine, this is the amount of confidence which people have in the mutual fund industry and the mutual funds, because instead of you directly investing as an individual, as a investor, what we do is that we give our money to some financial experts. They pool the resources from different people, create a pool, and from this pool they invest in equity or the bonds or the gold, the mandate which the investor has given, or the mandate which the mutual fund house has taken from the investor while launching a scheme. Suppose a mutual fund house launches a scheme of equity fund only, right? So then mutual fund will invest only in the equity, only in the shares. They will not invest in bonds, they will not invest in the bond. If a mutual fund scheme is relating to the bond, debt fund, we call it debt fund, in that case, the mutual fund house will invest only in the bonds, right? So means the mandate with the mutual fund house has taken for a particular scheme. In that scheme, it will be investing in only that asset class for which the scheme has been launched, right? So in this way, the people who are experts, who are professional, they manage their this pool of resources, and as the value grows of the investment, right, so they distribute this growth with the unit holders. Like unlike equity, we here each unit which you buy is called unit. That each element, normally mutual fund units are also in the denomination of 10 rupee per unit, right? If I invest 1 lakh rupees, it means I'll be allotted in the initial offer. If I invest 1 lakh rupees, and if the offer is new first time, then and the par value is 10 rupee, it means I'll be allotted 10,000 units of rupees 10 each. With the investment, with this investment, like I have made lakhs of people will invest, supposing in this scheme, or thousands of people will be investing in this scheme, and thereby it creates a pool. This pool will be invested by these professionals who are managing that scheme of the mutual fund in the asset class, and if the value of that asset increases, so will be the value of the units, that which we call it in the mutual fund language net asset value, right? So this we have discussed even lecture while talking about the mutual funds also. Then the other investment is derivatives. Friends, let me tell you, derivative is a very risky investment. But if you see the daily data of the stock market, you will find that if 20%, it is not a ballpark figure, I am just giving you an example. Out of the total turnover in the stock exchanges, that is the two stock exchanges if I name in India, that is NSE and BSE, whatever the total transaction, the total turnover takes place in a particular day, 80% of the turnover is in form of derivatives. It shows the number of transactions that place in the derivative. The question is, what is derivative? Derivative is not an asset in itself. It is a financial instrument which derives its value from some underlying assets. Suppose if you are talking of X company, which is listed in the stock exchange, and if that X company is allowed in the future and options, these future and options are two important derivatives, right? So people may buy the derivative, not the share of X company or Y company. They will buy the derivative of X company and Y company, right? And thereby the basic idea of derivative is price discovery. That price discovery takes place because the volume is large, and it takes place as a future also. In the future means after 1 month, after 2 months, 6 months. So, and the transactions are large, so better price discovery takes place of that asset, right? So derivative market is popular in India, not only of the equity shares, but also of exchange rate, but also of interest rate, but also of gold, right? So derivative is in financial instruments whose value depends on value of the underlying asset. If I say equity derivative, it means the underlying asset is equity. If I say gold derivative, then the underlying asset is gold. If I say exchange rate derivative or exchange derivative, it means the underlying exchange is exchange rate. Suppose there may be derivative of the price between dollar and rupee. So that is the basically derivative. Derivative does not have a physical existence. I have already told you it's a contract between the two parties, right? So the contract takes place that I'll, for a future date, this much number of shares or this much quantity I'll buy at this rate. So the price is there, the date is there, the quantity is there in future, not at the present. So the actual exchange is not taking place in the present. It's a contract for the future contract, right? So it does not have its value of its own, but its value depends on the value of the underlying asset. Then comes exchange traded funds. These ETFs, what are these ETFs? ETFs are, friends, the pool. They are the collection of group of stocks that are traded on exchange. Suppose I'm confused. There are 30 companies in the Sensex. There are 50 companies in the Nifty, which is the index of the National Stock Exchange. Sensex is the index of Bombay Stock Exchange, Mumbai Stock Exchange. So if I confuse that which share to buy, or which collection of shares or the bouquet of shares I want to buy, I'm not able to decide. And I feel that stock market will go up, the Sensex will go up, Nifty will go up. One course of action, which is easy course of action and which can give me good return, is that I'll buy Nifty ETF. Since in the Nifty there are 50 companies, so it is a collection of, it's a group of 50 stocks. The combined value of these 50 stock will increase. If it increases, then the value of my ETF will also increase, right? If I buy Sensex ETF, it means Sensex consists of 30 different companies. So if the price of the value of these 30 companies increases, the sum total of the value of these companies increases, the value of my Sensex ETF will also increase, right? So it is not one share or two shares. It is a collection of group of stocks that are traded on an exchange like individual stocks. And the transaction cost is quite low. So many people, instead of making investment through mutual funds, because the benefit of the mutual funds is you diversify your risk, because instead of investing in one stock or two stock or five stock, mutual fund houses who are experts, they buy basket of shares, number of shares 20, 30, and thereby the risk is being diversified. Similarly, while investing through ETFs, your risk is being diversified, right? So if you want to diversify your risk, and if you don't want to put your money in one stock or two stock or one asset class, you can buy of a particular asset class, the ETFs of that asset class, right? So ETF is exchange traded funds, is a very important and a popular form. It is not very, very popular in India, but it is fast getting popularity in India. World over, it is in the developed market, it's quite popular form of investment in the world markets. Then real estate investment. Friends, real estate investment is traditionally in India is a very popular form of investment. People do invest in commercial assets, people do invest in residential assets, and traditionally in India, people tend to make heavy amount of their savings, tend to invest heavy amount of their savings in the real estate investment, as the land is limited, because they presume the land is limited, the value of the construction, the price cost of the construction is going up over a period of time. So as the time passes, the value of that real estate will also increase. With this objective in mind, the people do invest in real estate. So real estate will give you not only capital appreciation, but it can also give you the regular income in form of rent, that is rental income. If you get a constructed house, if you buy a constructed house, constructed flat, right? So that can, and let it out, it can give you rental income, plus when the price of the flat, price of the investment increases, thereby you can make good profit out of it. Government schemes, right? There are many those people especially who are risk averse, who don't want to take risk, right? And those people who are satisfied with a reasonable return, and reasonable returns means that limited return because the risk is low. There are many government schemes, the national savings schemes, the Kisan Vikas Patra, the Public Provident Fund, national pension plans, post office schemes. There are a whole host of the government schemes through which you can make investment. And while talking of investment, we normally say that people also see that is it risk free? It is the degree of risk is involved. What is the degree of risk involved? Is it helps in saving my tax, right? So on these various counts, on the tax count, on the risk count, this is considered to be a very good form of investment, right? And over a period of time, your wealth increases, although it will increase gradually, because the expected return on these government schemes are not as high as the equity shares or the bond of the private companies. But those investors who are satisfied with a reasonable return, government schemes are a good form of investment, and these are hassle-free investments, these are risk-free investments, gives you regular income, right? Especially many people who are retirees, who have a limited investment, unlimited wealth, right? And with this wealth, with this amount, they want to spend their life because they are not in the earning age group, right? So suppose you have 50 lakh rupees and you invest this 50 lakh rupees in the national pension scheme. The amount, the interest which you will get out of it, you can make good money out of it. Or you deposit in the post office, you get 6-7%, 8% interest from that. Or you deposit in a senior citizen savings scheme, you get 8.2% interest at present. I'm talking of the current rate of interest, right? And you get from this interest income which you generate, you spend your life, means you get your livelihood. So there are a whole host of government schemes. Deposit related investments. And the best example that comes in mind is the banks. Banks in India, and traditionally I tell you, these deposit related investments are very, very popular form of investment in India. If you ask any Indian, where do you invest? At least some amount of money, those who have savings, those who are left with some savings out of their current income, they tends to make fixed deposits in bank. I'm not saying all, but many people in India makes at least some amount of fixed deposit in banks. Because why fixed deposits? Fixed deposits gives you a higher rate of interest as compared to the saving fund, right? Suppose at present the saving fund rate of interest is 4%, then the deposit rate, if you make 3 years FD, it is giving you 7.5%, 7.25% interest, which people feel that it is a risk-free investment, like treasury bills, like government schemes. It is also a very good, safe investment and gives a fair return, good return. Deposit rate investment is not only the bank fixed deposit, but you can make investment in even the corporates. The corporates, houses also, all good companies with a good balance sheet, clean balance sheet, do take money from the public as a fixed deposit. And they give normally the rate of return, which is higher than the rate of return of the bank FDs. Why they have to offer the higher rate of return? Because if the rate of return is same as the bank is offering, people tend to tend to invest in the bank FD because that is more safe avenue of investment. But when you are investing in a company FD, corporate FD, certainly people are taking some element of risk. And if there is an element of risk, right, certainly they would expect the return should be also higher. Similarly, it can be recurring deposits. Recurring deposits, like in the banks, in the post office, you deposit every month or every quarter or a fixed interval, I would say, right? Instead of one-time lump sum deposit, you deposit, suppose I am having a small income of 20,000 rupees. So I don't have a 1 lakh rupees to make an FD. What I have is, out of this 20,000 rupees of income, I am able to save 2,000 rupees per month. So instead of keeping this 2,000 rupees per month in my bank account or in my home, what I do is I take a recurring deposit in a bank, right? And every month I'll be depositing 2,000 rupees, and this way my money will accumulate, and over a period of time I will able to accumulate good amount of money, which will give me a return, a interest income, which is almost equivalent to the bank FD. Certainly on a recurring deposits, banks do offer, or the companies do offer slightly less rate of interest as compared to the fixed deposit that is being made in the fixed deposit. Because when you make deposit in a lump sum money, then one time you are making investment, normally people do invest some good lump sum money, but in recurring deposit people do invest in small money, right? So but over a period of time, this is good way of investment of their small savings and can give you these results. So friends, in this lecture I have talked about some of the investment avenues, popular investment avenues, in form of equity, in form of bonds, in form of derivatives, in form of mutual funds, in form of the government schemes, right? And the whole host of the government schemes, then bank deposit related investment, it may be bank FD, it may be companies deposit, like that. So these are the few popular investment avenues where people do invest in their savings and get good return or get reasonable return out of those investment. Again, these investments depends on various factors. We have talked this in my earlier lecture, and I will be talking about future also. Thank you.